When investors look at private credit headlines today, it is clear why questions are starting to build around the asset class. A few high-profile defaults have gotten a lot of attention. At the same time, concerns around AI disruption, especially in software, have added to the anxiety. But in our view, those headlines do not tell the full story. What we are seeing is not a broad crisis across private credit. It's a much narrower issue. Too much capital chasing deals at the larger end of the market. In fact, despite some isolated problems, default rates have been broadly stable, and in some cases even improving. That has been supported by decent economic growth, resilient corporate earnings, and lower short-term rates, which have helped to reduce debt service pressure. So the key question is not whether private credit still works. The more important question is this: where is competition starting to change the balance of risk and return? And that is where investors need to focus. Capital has become much more concentrated in the largest part of the private credit market. In fact, just 12 funds have accounted for more than 40% of global private credit closed-end fundraising over the last 18 months. That concentration has intensified competition in the large cap market. And in that segment, lenders are not just competing with each other, they're also competing with the broadly syndicated loan market. And that matters because when competition gets too intense, underwriting standards can weaken. We think the effects of that crowding show up most clearly in 5 areas, what we call the 5 Ps: pricing, portfolio composition, protections, prudence, and PIK. These are not broad weaknesses across all of private credit. They are places where crowding has had the biggest impact. Let me walk through them. First, pricing. One of the most common concerns today is spread compression. In simple terms, the extra yield investors earn over base rates has come down. And because Fed rate cuts have also lowered base rates, all-in yields are down from their 2024 peak. Even so, private credit still offers a spread premium versus public markets. And importantly, that premium is more attractive in the lower middle market than in large cap direct lending. Today, that is about 50 basis points of additional spread in the lower middle market, with another 50 to 100 basis points available in non-sponsored deals. So the takeaway is straightforward. Spread compression is real, but it has been most severe at the top end of the market, where competition is fiercest. Second, portfolio composition. Software exposure has come under a lot more scrutiny as investors think about how AI could disrupt business models. Now, so far, we have not seen evidence of broad credit deterioration across software, but the risk is clearly not evenly distributed. Over the last 5 years, technology made up only about 10% of annual deal count in the lower and core middle market. In the large cap market, that figure was 22%. And in jumbo loans above $1 billion, software has represented more than 40% of dollars deployed since 2021. So again, the issue is not private credit as a whole. It's where exposure is concentrated. Third, protections. Private credit built its reputation in part on stronger lender protections than public credit. And broadly speaking, that's still true. About 90% of broadly syndicated loans issued in 2025 were covenant light. In private credit overall, that figure was just 14%. But that headline hides an important divide. In the large cap segment, about 60% of loans were covenant light. In the lower middle market, it was only 3%. That's a major difference. When markets get more competitive, one of the first things that tends to weaken is lender protections. That is exactly why segment selection matters. The lower middle market today offers not just higher spreads, but also tighter loan terms, which gives lenders more downside protection. Fourth, prudence or leverage. This is another area where the broad headlines can be misleading. On the positive side, sponsor equity contributions are a higher share of buyout financing than ever, and loan-to-value ratios for new deals are around 45%. That said, investors still need to pay close attention to vintage risk. In particular, loans originated in 2021 and 2022 at high valuations and high leverage now look more vulnerable, especially where underwriting assumed overly optimistic earnings growth. And once again, the large cap segment stands out. Average debt to EBITDA there has risen to 6.2 times, the highest level since 2022. In the lower middle market, leverage has been much more stable, hovering around 4.2 times over the last 3 years. So prudence has not disappeared, but it is clearly less consistent in the more crowded parts of the market. Fifth, PIK, or payment in kind interest. PIK has gotten a lot of attention lately, and some investors see it as an automatic red flag. But the reality is more nuanced. Not all PIK is the same. Sometimes it is built into a deal from the start as a temporary structural feature. Sometimes it is used more aggressively to stretch leverage or win a transaction. And sometimes it shows up later in a restructuring or distressed situation. So the key question is not simply whether PIK exists. The question is how it is being used and why. Here again, the lower middle market looks more conservative, with PIK making up a smaller share of total income. That likely reflects the fact that more aggressive PIK structures are showing up in the large cap market, where lenders are competing harder for deal flow. So when you put these 5 Ps together, the story is actually very consistent. The pressures in private credit are not broad-based. They are concentrated in the parts of the market where competition has become the most intense. So our conclusion is this: private credit is not broken, but selectivity matters more than ever. In large cap lending, the opportunity set has narrowed as risk has risen. By contrast, in the lower market, where relationships, disciplined underwriting, and specialized expertise still matter a great deal, excess spread still has the potential to translate into real alpha.